Welcome to the Finance Underground channel. I'm Brian. Today we're going to talk about retirement accounts. So retirement accounts, there's a ton of different options, but we're going to boil it down to four basic accounts, the most common accounts today. So let me flip over to a slide here. So as you can see, the tax advantaged retirement accounts, there are many options. From your employer, again, you'll see typically a 401k or maybe a 403b or a 457b or a TSP. These are typically government or school accounts. The 401k is the most common. Then there's some employers are starting to offer a Roth 401k, and we'll talk about the terms and what the Roth means and what the 401k is. We'll talk about those in the video today. And the IRA, there are little known, typically for small employers, they can help you set up an individual retirement account as well. On the individual side, we have things like the traditional IRA, you have the Roth IRA, then there's a non-deductible IRA. If you're a high income earner, you can't participate in the Roth and other options, or if you have too much money, or you fully fund the other options, then the non-deductible IRA is an option. Then we have like SEP IRAs, solo IRAs, and simple IRAs that are designed primarily for self-employed. Today we'll primarily be talking just about the 401k, the Roth 401k, the traditional IRA, and the Roth IRA. So those four things. Okay, so what is 401k? What does that mean? So 401k is just all of these. So let's back up. So when you invest money in the stock market, you have a brokerage account and you put money into a brokerage account. You buy certain investments, mutual funds or stocks, bonds, that type of thing. Those are your investments in a typical brokerage account, and you have no tax advantages. If you buy a stock, it raises, you sell it, then you have taxes on that gain. So the IRS, in all their loving kindness, has come up with some tax advantage options for us to save money for our retirement. Okay, and that's what a 401k and an IRA. It's a tax shield. It's a shield from the IRS getting your money. So the 401k is a tax advantaged cover for those accounts in your brokerage account. So as that money grows, it can grow tax-free or it can grow tax-deferred. You don't have to mess with the taxes until later. And so that gives you some growth opportunities that you wouldn't otherwise have in a taxable account. So a 401k is an employer plan. Typically, employers will match your deposits. So they give you an incentive to invest in your 401k by matching what you put in. So this is rule number one with the 401k. Always take the full match. If your employer is going to match you dollar for dollar or 50 cents on the dollar, make sure you put in enough money into that 401k that you get the entire match. That's free money. My employer matches dollar for dollar right now up to a certain point. And so I put that money in. That's a 100% return. Guaranteed, immediate return. You can't beat that. It's free money. Take the free money. Fund the 401k. Rule number one with the 401k. So the 401k gives you tax advantages up front. When you put the money in, it does not count against your taxes. So the money goes in before you pay taxes. You don't have to pay taxes on that money. And then it grows tax deferred until you retire. You can start pulling that money at 59.5. And at that point, you pay the taxes on that money as you pull it out. Okay, so it's tax deferred. They're going to get their taxes one way or another, right? So if you pull the money before 59 and a half, there are penalties. There are some caveats and ways around that, and that's beyond this video. But basically, 59 and a half, you can pull your money without penalties. Before 59 and a half, you're going to pay penalties, or there are a few loopholes that you can get a little bit of that money out for certain situations. So there are required minimum distributions. When you hit 70 and a half, you are required to take that money. So if you have millions and millions and millions of dollars stashed in these retirement accounts, they're going to force you to take the money out starting at 70 and a half so they can get their taxes. So the contribution limits change every year. In 2020, you can put up to $19,500 for you young fellers, or if you're like 50 or older, like some of us might be, then it's $26,000 you can put into those accounts. So a Roth 401k is similar to a 401k, to the traditional 401k. The big difference is when you pay the taxes. On a Roth 401k, you pay the taxes today, and then the money goes into your investment. It grows tax-free, and you're able to spend that tax-free. Same 59 and a half withdrawal options. If you withdraw early, you're paying a penalty. Same required minimum distributions, same contribution limits. So very similar to a 401k. The big difference is when you pay the taxes. Are you going to pay the taxes today, or are you going to defer those until later? IRA. So an individual retirement account, contributions are tax deferred. So you put the money in before you pay your taxes. The money goes in before you pay your taxes, it grows tax deferred, and then you pull them out after 59 and a half. You can pull that money out and you pay the taxes at that point. Very similar to a traditional 401k, the traditional IRA taxes work very similar on those, the contributions and the taxes. So you'll also have the same 59 and a half early withdrawal. You'll get penalties. There are required minimum distributions. You've got to, they force you to pull that money when you hit 70 and a half. If you're not pulling enough money out of that, they're going to force you to pull it out so they can get their taxes. And the contribution limits for 2020, $6,000 if you're under 50 or $7,000 if you're over 50. And remember, those amounts change every year, so check those numbers. The Roth IRA. So on the Roth IRA, similar to the 401k, the Roth 401k, it's just the big difference is when you pay the taxes between the traditional and the Roth. The Roth, you pay the taxes today, and the money goes in after taxes and grows tax-free, and then you can spend it tax-free. So the Roth's a pretty good deal in a lot of ways. All right, you have less money going in because you're paying the taxes today, but it grows tax-free and spends tax-free, which is pretty good. There are income restrictions on the Roth IRA to participate. Singles is about $124,000. If you make over that, then you can't participate. And if you're married filing jointly on your taxes, it's about $196,000. And again, those numbers change from year to year. So check those numbers to see if you're eligible. The really nice thing would be is if you're making too much money and you're not eligible for those and you have to put your money somewhere else. That would be fantastic. Again, with early withdrawal penalties apply. But with a Roth IRA, you can pull out your principal that you've put in at any time for any reason. And you can pull out money from your Roth IRA for a first-time home purchase and for college expenses. And the college expenses can be for you or for your children. So that's a pretty good deal with the Roth IRA. It's a way to get money out before you're 59 and a half. There are no required minimum distributions on the Roth IRA because you've already paid the taxes up front. So that money can sit there as long as you want. That's a good fund you can pass on to your children if you want. I personally just spend the money, but you can pass it on to your children if you want. Don't want our kids fighting over the money, right? We might as well just spend it. And the contribution limits are the same as the traditional IRA. So, and those change from year to year. So check those numbers. So how would I use these accounts? Typically, well, always, rule number one always applies to 401k. If you have a 401k available to you from your employer and they're matching you money, always take the full match. That's rule number one with 401k. If it's available, take the full match. Get that money. It's free money. Number two is open an IRA. If your income is to the point where you qualify for a Roth, open a Roth IRA, fund that fully until you start making too much money to qualify or until you start getting killed with taxes and you need the tax deduction. So fund the Roth IRA fully until you roll over income-wise or tax-wise and start funding a traditional IRA. So one is the 401k, two is an IRA, either the Roth or the traditional. And then three, you can go back to that 401k and fully fund the 401k. And then you have two options after that. One, if you plan on retiring at 59 and a half or later, then you can go into a non-deductible IRA. You don't get the tax advantages up front, but it grows tax deferred. There's a little bit more bookkeeping on that one because the principal and the interest has to be tracked separately. But if you want that tax deferred growth for long term, that is an option. And you can fund your taxable account. So number 5 is to fund your taxable account with any money left over. So 401k, IRA, go back and fully fund the 401k. If you still have money left over, then you can debate between a non-deductible IRA or a taxable investment account. And if you plan to retire early, then you're gonna still take the 401k, still fund that Roth IRA, and at that point you're gonna switch over. Instead of fully funding that 401k back in there, you want to move over to a taxable account. But this is if you plan to retire early and you have a killer plan, a great income, and is this a realistic thing? You need to run some realistic numbers. Can you retire early? If the answer is yes, and you need some money, you're going to want a little bit of money in a normal investment account. You'll want some money in a taxable investment account so you can pull that money before you're 59 and a half. Okay, so lots of jargon, blah, blah, blah. One note in closing here, we're going to talk about 401k. When you leave the employer, you can take that money out of the 401k and you can roll it into your own IRA. I would recommend doing that. If it's a Roth 401k, it rolls into a Roth IRA. If it's a traditional 401k, it rolls into a traditional IRA. So how do you get started? One of the easiest ways to get started is to set up an account with M1 Finance. They have free trades. You're able to buy fractional shares. You can start with minimum dollar amounts. I'll put a link. It's an affiliate link in the bottom in the description. If you if you fund your account at $100 and open a Roth IRA and fund that at $500, they'll give you a $10 thank you. And I may get a kickback on that as well. Nothing comes out of your pocket, of course. That's thank you from M1. Get started today. Open an M1 account and start funding that. If you don't have the $100 to start or the $500 for the retirement account, just open an account and start putting $10 a month into it. It'll start to build up. You'll get some traction. It gets exciting. It's kind of intoxicating to see the money grow. And so start today, get an M1 account, fund that. You get fractional shares. And so you can start with as little as $10. So get started today. So what fund do you put that in? Now there's a good question. Well, according to several people, Mr. Money Mustache, J.L. Collins with the Simple Path to Wealth, they recommend buying the Total Stock Market Index Fund. In M1 Finance, that fund is the VTI. So if you open an account with M1 Finance and purchase VTI, which is the Total Stock Market account, that's what I would do. But again, I am just one random dude on the internet. I just have a passion for finance. So you do your research, you figure it out for yourself. That's what I would do. Open an M1 account today, fund it, at least $10, get the $10 a month going in there. Thanks for being here. Hopefully this has helped you clear up some of the mystery with the retirement accounts. Go ahead and comment and suggest topics, things you want me to cover. And go ahead and subscribe so you don't miss anything. Ring the bell so it notifies you when a new video comes out. We'll see you soon. Remember that your money is making somebody rich. Let's make sure it's you. Thanks for being here.